Hi, my name is Simon Snowder, and I'm going to talk with you about growth stocks. So why do growth stocks tend to negatively react towards inflation? That's what I want to explain you and the background story behind it. So first of all, what is a growth stock? A growth stock is a company that says that they will grow their revenue exponentially, so more than the average in the market. So let's say, for example, there's company X. Company X says that in 9 years from now, they will double their revenue. So in 9 years from now, their value of your investment should also be doubled. That is great on paper, but now comes the inflation in play. So right now we have 8% inflation. 9 years from now, with 8% inflation, 100,000 becomes 50,000. So when you look at your 100,000 becoming 200,000, you're also losing with inflation right now 50,000. So you made 100,000, you minus the return that you got from inflation, so inflation adjusted. So in reality, you're only making 50,000, which is still not bad. You made $50,000, 50% in 9 years, but it's not as good as it should have been if inflation was low. And that was always the case. Inflation was always low, but now inflation is high. So that's one of the reasons why growth stocks are heavily tumbling right now in the stock market. And another thing is that growth stocks typically say that they like to burn cash. They're proudly saying we will throw money at increasing our users, and therefore we are willing to sacrifice profits. They raise capital as well to do that, and when inflation is high, the problem is that actually money loses value in the future. So money today is as much valuable as it can be. So if you are going to say that you're going to burn cash, you're burning something more valuable with high inflation than it normally is, because companies that make right now money, they are the ones that are in a better position because they are creating money today instead of burning cash and promising that they will make money in, let's say, 9 or 10 years. So that's another factor why inflation is also not good for growth stocks. And what we're looking at also in general is that when you are looking at being rewarded in the future for gains, in general, what you see is that it's a long-term game. You're sacrificing the cost of opportunity that you can make with your money today so that you can have a growth in the future. So when you look at all these data points and you see suddenly that it's changing the scenario, then the data says that maybe 2 years ago it was a good bet to invest in growth stocks, but today it looks different. And that is the whole change in landscape that we're seeing now with growth stocks. Another factor that is playing with growth stocks is that every time you also grow, you're doing that based on factors, including that your spending is also going to compromise the cost of acquisition. So the cost of acquisition of users, and that those users will be able to spend on your platform. Let's say, for example, Amazon. Now what Amazon is realizing now is with inflation is that every single product that they are shipping and that they are buying, and even shipping cost, is because of inflation is rising. So their cost is increasing, so their profit margin is being squeezed as well. So that is another thing that is hitting certain type of growth stocks. So I just want to throw this out there because there's an economic formula which says that at certain moments your cash is worth more than in other moments, and in other moments it is better to invest in growth stocks with lower inflation or with higher inflation. So this can change as well, what I'm saying. So I'm recording this video right now, today, on this date, but maybe in 1 or 2 years, there could still be high inflation, but the situation on other factors can be favorable again towards growth stocks. So that's why what I'm saying doesn't necessarily mean that it's set in stone forever. But what I can say is that growth stocks typically also rely, specifically when they are still in the early stage, is that they rely on injections from capital, and that capital comes normally cheap when inflation is lower, because when inflation is lower, the interest rate is typically also lower. So borrowing money is also less expensive. So that's where we will see a combination now, where inflation is rising, interest rates are also rising, and because of that, what we are seeing now is that it's becoming more expensive as well to borrow money. And that's why you see, for example, in the startup industry, that venture capital funding has gone down drastically, because they need to pay more for borrowing that money, and they cannot bet on a long-term recovery of their money at the same way as they could have done like 2 or 3 years ago, when the interest rates were low and inflation was also low. So it's not only impacting companies that are already publicly listed, it's also impacting startup companies, which normally get easy funding because they say we will exponentially grow. My name is Simon Snelder. I hope you enjoyed this video, and hope to see you in my next video. Goodbye.